Now friends, come to this particular question ID number 45. Okay. Now, as I already told you that you should have read the question. So you should read the question 2 times, every question before you start the class. Okay. Now, this is a question where see the entire profit and loss figure has been given to us. Gross profit brought down and you have a net profit. All the figures are in thousands. Okay. So we will start with profit as per P&L. You can start drawing the columns. Profit as per P&L 93,950 and all the figures are in thousands. So you can add the zeros or you can keep all the figures in thousand. The choice is yours. Okay. And to this you will start doing add less adjustments. Okay. All the add less adjustments, whatever that you do. Okay. First we should, as far as possible, and this will be more what should I say, a favorable thing to do in an examination condition, is to consider the additional information first. After that, we will consider all the credit items and all the debit items. Okay, and this is how we are then going to wind up this particular question. So you start drawing the columns and start solving as and when I'm telling you. Okay, so I'll keep on telling you that you do the adjustment and thereafter you take the total by yourself. Okay, now repairs of the building include 95,000. Repairs of the building include, where is the repairs of the building? Let me check. Repairs of the building. Okay, this figure, which is already debited, includes 95,000 cost of raising a compound wall for its own business premises. So repair on building, it is raising a compound wall. Okay, so here is something where you have to take the decision whether the expenditure is a revenue expenditure or a capital expenditure, because section 37(1), which I already explained that to you, a capital expenditure is not allowed as a deduction. So raising a compound wall is basically a value addition to the building, and therefore 95,000 being a capital expenditure, it should be added. Okay, so add 95,000 rupees. Okay. However, now see, I think in this particular question that depreciation on building and all that is not given. So that depreciation point, because see, if you are going to add the cost to 95,000 to the building, then the appropriate depreciation on that 95,000 also should be allowed to as a deduction. Naturally, because to that extent the block will get increased. Now that block etc., the data is not so far given to me in the question very clearly. If I come to know that opening WD of the block was this, and if I get that kind of data, I may adjust it. But right now I will add to the profit, reason being that this is a capital expenditure and therefore it is not allowed. However, if you want to write a note for that, on 95,000 rupees, the appropriate depreciation in the respective block of building should be given, and naturally should be given, but because of the lack of data which is not present in the question, you are not considering that. Okay. Further, interest payment include interest payable outside India to a resident Indian on which TDS has not been deducted rupees 12,000 and 12,000, and the penalty for contravention of the GST is rupees 24,000. Assessee has incurred the expenditure relating to the exempt income and the same was charged to the personal account, not debited to the P&L. Okay. Now, first of all, interest payable outside India is 12,000 and the tax has not been deducted. Now friends, one very important disallowance from the business income point of view is a failure on the part of the assessee to do the TDS compliances. So there are different types of transaction. I will take you to that particular provisions, and if you fail to do TDS compliance, then there will be some sort of a disallowance. Okay. So first of all, let me go to section 40 small a and let me bring that particular provisions to your notice. My baby is scrolling. One second. Now pay a little bit of extra attention under section 40 small a. Yeah, okay. See, understand the interpretation very clearly, and this interpretation will be very much helpful even in our international taxation discussion, which we'll do it afterwards. Okay. See, section 40 small a, the title says The following amounts shall not be deducted in computing the income under the head PGBP. Shall not be deducted. Okay. Basically, section 40 small a is a type of disallowance where the TDS compliance have not been done. I repeat, where the TDS compliance have not been done. Okay. Now, this is divided into different parts. See, 40 small a subclause 1. First of all, let me chart down the section number C1A. Okay. And 3. 40 small a 1, 1a and 3. Okay. Now, 40A1, where there is any interest, royalty, fees for technical services or any other sum chargeable under the act, or any other sum which is chargeable under the act. So if the amount is chargeable under the act, which you are making a payment outside India, or if you are making a payment in India to a non-resident, not being a company, or to a foreign company. That means you are making payment to non-resident or a foreign company. Okay. Or if you are making payment outside India. This is the situation. Okay. In that particular case, if the tax has not been deducted, okay, or after the deduction it has not been paid. So not deducted or not paid. That means government is losing the revenue on account of taxes. If government is losing that particular revenue on account of taxes, okay, then this particular money, interest, royalty, fees or any other sum will not be allowed to as a deduction. It will not be deducted while computing the income. Now, if you see the first part of the transaction, listen very carefully. This outside India you are paying, but you are paying it to a resident person. So if you look at this particular provision, any payment you are making outside India, so whether outside India payment you are making to resident or a non-resident or to a company or anybody, if you are paying outside India, then subclause 1 is applicable. In that case, 100% of the expenditure, that is the entire expenditure, will not be deducted. It will not be deducted. We call it as a 100% disallowance. Okay. So, first of all, I can straight away conclude here that interest payable outside India, so plus 12,000. Okay. It will not be allowed to you as a deduction. Okay. Now, in the current previous year, I will disallow. So, entire 12,000 has been added back. So, our current year discussion is over. But supposing if the TDS payment, now actually it is not part of the question, but I will tell you. If the TDS payment is done in the next year, so next year you pay the money on account of TDS to the government. In the next year, will you get the deduction? Yes, definitely. So whatever is disallowed in the current year will have to be allowed in the subsequent year, if in the subsequent year the TDS compliances have been completed. So year in which the government will get its revenue, you will get your deduction. It's a simple trade-off. And that kind of provision is also very routine thing. See, where any sum the tax has been deducted in any subsequent year, it shall be allowed in the year in which such monies has been paid on account of TDS to the government. Finish. So year in which you pay the money, that particular year, government will give you the deduction. So in the current previous year, because of this provision, I have added 12,000. If I do the TDS compliance in the next year, then I will deduct 12,000 in the next year income. As simple as that. Because after all, it is an expenditure. So it should be allowed as a deduction. Year in which you do the TDS compliance, that year government will give you the deduction. Okay. So that was because outside India. Okay. Now, further. Penalty for the contravention of the GST. Now, any penalty for the infraction of the law is not allowed as a deduction. In fact, explanation to section 37 also comes into the picture here, and there are many court cases also which comes into the picture. If you incur any expenditure in the contravention of the law, that means you have violated the provisions, and thereafter you are trying to get that particular deduction. Now you cannot get it because there is a violation of the law. So the penalty generally is not allowed as a deduction. Now some textbooks and some people, they say like that, if it is a fine we will allow, and if it is a penalty we will not allow. There is no hard and fast rule. There is no hard and fast rule that fines are allowed and penalty is not allowed. Not like that. Basically you have to see not by the name, the nomenclature, fine or a penalty, whether there is a contravention of the law. But normally whenever the word penalty comes, there is a contravention. It's a general understanding of the law, and therefore plus 24,000 you have to add to the income. Assessee has incurred expenditure relating to the exempt income, and the same was charged to the personal account and not debited to the P&L. So the expenditure for the purpose of earning exempt income is not allowed. So normally I should add if there was expenditure, if it was debited to the P&L, but nothing is debited to the P&L, and that's the reason I will not do any adjustment. Because see, when I started my I have started from profit and loss, that is 93,950. That is the way I have started my answer. Okay, so I have not debited only. That means I have not taken it as an expenditure itself. So there is no question of disallowance. In fact, it is not a allowable item, but it is not debited to the P&L in the given question, and therefore no adjustments are required. So no adjustment there. Okay. Now salary to staff includes salary paid to manager 40 lakhs. Now tax have not been deducted, but Mr. Himant Sanghai has in Bangalore has filed the return and paid the advance taxes duly. Beautiful. Now this particular transaction is paid salary to the manager